Hello my fellow freedom builders and welcome back to the channel. As you know, it is earnings season and therefore I've done some video about different of the large companies that have come out with earnings. I've also gotten requests and one of them is Microsoft. So of course let's do Microsoft today and let's just do it in this short form that I normally do. That leaves something up to you to decide what you believe in for the future of Microsoft. But I can see that it's a form that many of you like, and I'm not trying to guess about the future, but we can have a bit of a discussion about what we believe the future growth could be from a company like Microsoft, and the other day was Google or Alphabet. All right, first of all, we can see that it has a stock score of 80. The reason why it's only 80, you could say, is that the value score is 11. That is quite low, and that is of course an automated score that is in the system here. I actually think there is more value in it as such, but some of the value scores, for instance the PE ratio, is fairly high, you could say, but looking down at the PEG ratio where we are comparing the PE ratio to future growth, we can see that the PEG ratio is only 2.2, which is relatively low. They also pay out a dividend. That is not something I look too much at myself. We can see that the return on capital, return on equity, they are outstanding and they have a fantastic operating margin. Now, when you decide what you believe about the future, of course, you will have to go in and have a look at something like the operating margins and see, are they improving, are they going down? And you can see, for instance, the operating margins here have gone up over the last 5 years from around 32 to around 42, dropped a bit since last year. And also when we're looking at the earnings per share growth, that has been outstanding, dropped to near zero here in 23, but is projected to go up again. And they have had an average CAGR in the earnings per share growth at 26%. Let's remember that number because that is important when we do our discount cash flow. All right. When we look at the overall company health, the bankruptcy score and the risk here and the overall analysis estimates, they are very good, all of them. They have very nice cash flow, free cash flow. That is something I look for. Again, it has dropped since last year, but it's not dramatic. All in all, this is just from a very quick view, zoomed up. This is a decent company to dive further into. And as always, I try and start out with a very short-term view. First of all, we got the last time it shifted from red to green and the long-term trend was back in March here, where we could have gotten in. I would probably have waited to somewhere around up here in the 280s here, and then you could decide whether you want to go out when we had the green signal and go in again at the red signal and go in again when we had all greens, and how you want to time it. This, for instance, would be a very good buy signal for me when the TPI on a weekly went into an oversold accumulation here. I could have bought it around here in the 330-ish here and taken it up here. It has dropped almost 10% lately, but that is not something that really bothers me in the big picture. Right now, I would like to see a bit of a green day. We might actually have that today. Let's just have a quick look here. We have in trading view, we have the regression channel. We can see that the weekly chart, it's just challenging the bottom line here on the regression channel. On the daily, it has went all through and we are going up today. We already had the earnings, as you know, and I suspect we will be moving up again here. I would like to see a bit of green confirmation before doing so. So it's not the worst of worst signals. I would like a bit more confirmation, but it seems like the stock is finding some decent, solid support down here in this area. So I don't believe it should go down a lot more, but again, I could easily be right. No one knows the future for the price of a company. Looking into the value chart, it could seem like the price here is fairly much above the overall value. You could say, okay, within the next 2 years, if the investors are willing to keep paying the average price earning, and if the estimates they hold through, then okay, then we are at a fairly okay level here. But nothing much on the upside. However, as you can see, we are at 2023 right now, and the average price earning is actually 29, almost 30 here, whereas the actual price earning is more like 35. They are projected to drop a bit, but let's have a look at if this 30, 32, 33 can actually be true. We can try and have a look here, go a bit down to see if we can find a year where these two align fairly okay. And I think we should get down into these. Let's see, maybe we should all the way down to 1 year. Yeah, of course, the average equals the actual here when it's only 1 year. If the price earning can stay at 35 as it is now, and we have a price at 330 here, then if the estimates come through, then we actually could see a price above 400 in a couple of years. If the price earning will be more in the area of what is projected, maybe let's just have a quick look. Yes, maybe more like the 31, 32-ish here, then yes, we are at the 330 level, and 360-ish here could be a reasonable level to aim for, meaning that there is at least 10% upside over the next couple of years. Now, there can easily be more. This is just if the price earning and estimates hold through, and the stock doesn't get hit by AI hype or whatever everyone wants to own it. Then it can easily go further up, and it can also drop further. But let's have a look at the discounted cash flow here, because as of right now, there is a 10-year average growth in earnings per share at 18.80%. If that is true the next 10 years, and we want a discount rate, meaning a yield every year at 10%, then Microsoft is slightly overvalued. A fair price right now would be 307, and that would, at a growth at 18.8% per year the next 10 years, that would give you a yield of 10%. But as you know, there are some levers here we can pull, and maybe we can say at the PE right now around the 30, 34, that gives us if we are satisfied with that, it actually gives us a discount rate at only 3%. That is 100 divided by, let's say, 33. Now, if they can grow by 18.8%, then a fair value right now would be 656 compared to the 330 right now. So that actually gives a lot of margin of safety to us. However, it might be that it can only grow by, let's say, 15%, which I think is a fair estimate. We can also go as low as 12%. Even at 12% growth per year, a fair value right now would be 394, which actually leaves a lot of room for maneuvering here, a lot of margin of safety. We could go as low as 10% here, around 10%, maybe even 9, yeah, just around 9.5%. That would give us a fair value where we are at right now. So, but that of course is at a yield, a demand of only 3%, a discount rate. I would personally say, all right, 5 is maybe more reasonable, because it actually leaves some decent yield inside the company, and that means the company should grow by 13% over the next 10 years. And you know what? I actually think that is doable. 5 years average is 32.5%. I know it has been low for the last year here, but actually over the last 10 years it has had almost 19%. And even if that drops to the 13%, if I want a discount rate of 5%, meaning a price earning of 20 or something like that, we are at a fair value right now, and I should be able to get at least the yield of the internals in the company of 5%. That doesn't mean it can't grow more than that, because again, as you know, maybe all of a sudden investors are willing to pay a PE of 40 or 50 or whatever for the company, and that would just explode the price even more. It could also be that investors overall get more risk averse, and they're saying, no, we only want to pay 15 for the in price earning, which actually means that we should be closer to maybe 7 in discount rate, and that would mean that the stock is actually overvalued. So People saying that they know exactly where this stock should be and what price earning will be in the future, they are either kind of delusional or lying or both. But I think it is fair to assume that 12, 13, 14% growth rate is something that Microsoft can actually keep up. And at that growth rate, depending on what your discount rate is, of course, what you demand in yield, then Microsoft seems to be very fairly valued right now. I have it in my own portfolio, I should say, in my large US portfolio, but I actually think I might be buying a bit more of it, or maybe selling some. I might be selling some cash secured puts on it to get some option premium. That's all for now. That was just my opinion on Microsoft. You are as always welcome to give your comments as to if you like it or don't like it or think it's over or undervalued. This is just my opinion. Remember to use your own methods, strategies, risk management and all that sort of tools, because this is absolutely not cut and stone. This is not the overall truth. Just my opinion. That's all for now. Take care of yourself and your money out there, and I'll speak to you again shortly. Bye.